Implied volatility is hands down the most important aspect whenever it comes to options pricing, but everybody loves to overcomplicate it. So in today's video, I'm going to be simplifying this options trading concept and showing you how you can use it in your trading. The definition for implied volatility, according to Investopedia, is a metric that's used to capture the market view of the likelihood of changes in a given security's price. So to put this in simple terms, this is how much buyers and sellers of a specific option expect the price of that option to change. So basically, this is the expected move of the option, but how do we come up with the expected move? Well, it's based on a very simple principle that you would learn in Economics 101, and that is going to be supply and demand. The more demand there is for a specific option, the higher the value of that option is going to be. If there's more buyers that are willing to pay for that option and buy that option, the price of the option is going to reflect that. You can kind of think of this like regular ass stocks. The more people that want to buy into a specific company, the higher the price or the higher the valuation that company is going to have. But if there's more sellers, then the price of that company is going to sink. So if you have a bunch of short sellers, for example, then that is going to drive the price of that stock down. And the same goes for whenever it comes to options trading. If there's more sellers, more supply for that option, and there is demand for that option, then the price of that option is going to reflect that by coming down. So basically what we're getting at here is whenever there is more demand for an option, there's going to be a higher price that you're paying for that option, which means that there is more implied volatility for that option, because if there's more buyers, then those buyers expect the option to make them money. Obviously, they wouldn't be buying the option if they didn't think that it was going to make them money.
You guys are getting paid?
So the more buyers there are for an option, the higher the implied volatility and the higher the price for that option. And this means you could potentially be overpaying whenever you're buying an option that everybody else is buying right now. Just like how everybody was buying into the bull market over the last couple of years into every stock you could imagine. And now a lot of that buying has dried up in specific companies, and the price of those companies have come down. And the same thing goes for whenever it comes to options trading. If there's less demand for a specific option, the price of that option is again going to come down, and you're likely to overpay for an option if you're buying it when everybody else is buying it. So say you're buying an option ahead of an earnings report, everybody else is probably having the same idea that you are, thinking that the stock is going to go up a lot or go down a lot, and they'll be buying a lot of puts or a lot of calls if they think the stock is going to go up. And the price of the option is going to reflect that before an earnings report. And this is where you run into what's known as Ivy Crush, when everybody decides that, well, the stock didn't move enough, I didn't make any profit, so they decide to sell their option. And implied volatility is actually very option specific. It's not the entire option chain that everybody is buying. Everybody loves to buy either super far out of the money options, that way they can turn, pennies into hundreds of dollars, or they like to buy very short dated expiration dates. So leaps options are going to have less implied volatility. So the longer your expiration date and the further away from the strike price that the stock is trading, the higher the implied volatility is going to be for that specific option. You can think of it like this: an at the money option, or a option that's trading right at the current stock price, has about a 50-50 chance of making a profit for the trader. And who wants to take a coin flip? But if an option is super deep in the money, then there's a greater chance that that option is going to make them a profit, or they'll at least be able to exercise that option. So there's going to be greater demand for that option, which means that the implied volatility for a deep in the money option is going to be higher. And finally, if an option is super far out of the money, then it's going to have next to zero value, which means that people can buy more of that option than the more expensive at the money options. So super far out of the money options and super far in the money options are going to have higher implied volatility. And again, the longer your expiration date, the lower the implied volatility is going to be, because everybody right now is focused on the short term and worried about the long term. But how can we use this information that we have about implied volatility to better our trading? It's actually extremely simple, and a lot of traders love to overcomplicate it, but it really just boils down to buying an option whenever it's cheap or whenever implied volatility is low, and then selling an option whenever implied volatility is high and the prices are high respectively. So we want to be buying options when implied volatility is low, selling options whenever implied volatility is high. But how do we know when implied volatility is high? Well, we can look at a metric like IVP, or implied volatility percentile. And this is going to tell you what the current implied volatility is compared to the past implied volatility given the range that you're looking at. So if I'm looking at, say, a yearly chart and the IVP says something like 90, that means that the implied volatility is in the 90th percentile. That means that implied volatility is pretty damn high, and you probably should be buying options. You should probably be the seller for those options instead. And you can really think of this like the bell curve, but for implied volatility. And if we go by statistics, we shouldn't be buying options whenever IVP is above 84.2%. Instead, we should be selling options whenever it's above that level. And whenever IVP is below that, then we need to consider our options, and we need to consider how much we think the option is going to move versus what the markets are expecting that option to move. And it really comes down to how much you think the stock is going to move itself. If the expected move, which you can also find on Thinkorswim, is greater than you think the stock is going to move, then you should be a seller for an option rather than being a buyer for that option. But if you think that the stock is going to move more than what's expected, then you should be buying options. That way you can get a little bit of arbitrage or leverage buying that option and selling it at a higher price. So really it just boils down to, what is the expected move? Do you expect the stock to move more or less than the expected move? And then you're going to choose whether to buy an option or sell an option accordingly. If you think that the stock is going to move more than the expected move, you're going to be buying options. If you think the stock is going to move less than the expected move, you're going to be selling options. It's really that simple. And whenever implied volatility is high, we want to be selling options. And whenever implied volatility is low, we want to be buying options. And that's how we can use implied volatility in our trading to decide whether to buy an option or sell an option. And remember, implied volatility in the price of an option is simply the function of supply and demand. So when everybody is buying options, then you want to be a seller. And when nobody is buying options, you want to be that buyer. So that's implied volatility in a nutshell for you. Hopefully this video was useful. If it was, leave a like down below. Thanks for making all the way to the end of this video, and thanking all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys. Never get you anything with that evil smile. Everybody's got a drug dealer on speed dial.